This is the Buried in Work podcast, where we share tips and interview experts to help you simplify estate planning and end-of-life tasks.
I'm your host, Adam Zuckerman, and today we have a very special guest, Steve Selengut. Steve is the author of Retirement Money Secrets, a book that explains the 6 basic principles needed to safely steer investment portfolios into and through retirement without dipping into principal. He's a 40-plus year professional investment manager that used to manage more than $110 million, and he now provides financial retirement strategies that ensure that his clients' assets are protected and efficiently transferred to their beneficiaries when that time comes. Today, Steve's here to share his insights on income-focused investment strategies and how they can help secure a financially stable retirement. Welcome, Steve.
Adam, it's good to be with you.
I'm glad you're here.
I've been looking forward to this conversation.
Me too. Now let's hop in. So you used to manage other people's money, 43 years, like we said, over $110 million assets under management. You sold your business for an offer that's too good to refuse. Tell us a little bit about your background, how your experience led to where you are now, and what people should know about you.
It's an interesting story. I guess I grew up in Northwest Jersey. My father was a builder, developer, real estate guy. And he actually, of course, I didn't know this when I was 12, but I certainly figured it out when I was around in my 20s and stuff. He had what we were told in college was a vertically integrated business, meaning that in building and real estate development and selling homes and all that stuff, he had it all covered. He had a lumber yard. He had an insurance business. He took back the mortgages on houses he sold. He had rental properties because we were lived in a mountain lake environment, 45 minutes from New York City. So it was summer rentals were, just there. So he had all this cash flow, all this income. And he used to explain to me how it wasn't so much the value of the properties or the value of the overall property and that kind of stuff that was important. The important thing was the income that his enterprise generated that allowed him to take advantage of opportunities that arose. So he had enough income coming in. In other words, if a parcel of land was for sale somewhere else, he had the cash to do it. He didn't like to borrow money, but he had the cash to do what he had to do, as well as to live well and to at least send one of his kids to an Ivy League school. The other younger one decided he didn't want to go to an Ivy League school, but he wound up with the money that was put aside for that Ivy League school. So at 25, I got an investment portfolio that became my instant responsibility, and I was determined not to lose any of it. And I was fortunate that I had a broker who really educated me on what all this stuff was. What's a stock versus a bond? What's a dividend? Why are they important? All this kind of stuff. The market cycle. Look at how IBM's price goes from here to here to here almost forever, always going up and down, up and down. So many opportunities to trade it. But while knowing you're in a solid company without the risk that most people have where there has it, this company's not going to make it, this company's not going to, who knows, you don't worry about IPOs, things like that. You buy solid companies and you trade them and you get the income, and the income you use to broaden your base of companies. Just like in real estate, you broaden the number of properties and everything's paying you income and so on. So that's what I did. And I was commuting to New York to a job with a life insurance company, actually, although I wasn't a life salesman. And I had a job there that was very interesting, though. It was with their pension department. Mm-hmm. And I had to do a lot of work with the finance guys and look inside the portfolios, the defined contribution plans that they ran. So I learned a lot about what they selected in their portfolios and what they were doing for their employees. And I was one of those employees that was in that plan. But anyway, I was making very little money with them. And I looked around and looked around and looked around, and I saw that my portfolios in dividends alone were making as much as my salary. And when you add in all the profit taking and stuff that I was doing in addition, I was making significantly more. And by the time that was 1970, when I started investing, and by 79, I was making 5 times my salary, even though I'd gotten minimum raises during that period of time. So I just pretty much up and left and said goodbye. And I was determined to do that for other people. Right. And I I got two clients who looked at my portfolio, looked at where it had come from, and said, "Look, yeah, you can do that for me," and I did. And then I got more and more and more of similar, and the rest is history.
So you fast forward, you sold the company, offer too good to refuse, as we mentioned. And today you're focused on teaching your customers, the listeners of the podcast that you go on, those who you engage with, how to continue to grow their income and capital regardless of where the markets are going. This is long-term income independence. Now, given the current economic climate with market volatility, that almost sounds too good to be true. But what are some of those most crucial strategies from your book that our listeners can focus on to ensure that they achieve and maintain their long-term income independence?
Okay, well, you just, in that sentence, but with a negative connotation to it, you said market volatility. Yeah. Market volatility is one of the single most important benefits that the markets provide. The fact that prices fluctuate and that at the same time the dividends don't fluctuate. So it's just like the property values go up and down, but typically the rents are pretty dependable. People pay even in the Great Recession, there were companies who had trouble with debt, but 99% of the people who had mortgages paid their bills. There weren't a lot of defaults in the private mortgage market. There just weren't. So this is a stable income type environment that benefits when interest rates go up, the prices of your bonds, as good as they are, even treasury bills, go down and you can buy them at a discount, So just because you originally got them with a 4% yield, if interest rates go to 6%, their prices are reduced, so you can buy them and they're a 6% yield because you bought them at a discount. So that's the great thing. A lot of people look at bonds as really scary because they go down in price. That's a benefit because they don't stop paying their dividends. The government, of course, if the government goes out, we have a problem. But that doesn't happen. So interest rate cycle, market cycles, the same thing. Companies like your big board, your Dow 30, the best companies theoretically in industry throughout the country or the world, and even the S&P, and perhaps even the NASDAQ. There are enough of those that are good quality companies that you can benefit by buying low, but only if you figure it out that you have to sell when they go up. You have to set target. I talk in the book about 6 really important things. 4 of them are risk minimization techniques. And we should go through them, I guess.
Let's do it. Let's start at number 1.
The first is quality. And quality is always job 1, just like at Ford. You have to know and determine, how do you determine the quality of a security you're buying? One of my points with common stocks was always that it paid a dividend. That means it had making enough money to pay it and respected its share owners enough to give them something for the use of their money. You'd look at things like PE ratio and debt to equity, how much borrowing, how much leverage does it use to run its operation, those types of things. So there are several elements to determine quality. And then the next is...
Well, let's hold you there for a second. For absolutely. Those listeners who are getting into investing earlier in their career or just quite frankly aren't familiar with it, can you explain what a dividend is?
Yeah, a dividend is a part of it's part of the after-tax profits of a corporation that the corporation gives to its shareholders. Just because. Just because it should. It's a share in the profits of the corporation.
So if I own 1 share of Dow and Dow gives a dividend, I would get that dividend amount per share on a regular basis.
On a regular basis. Typically, stock pay dividends quarterly. The same 3-month separation all the time. And they rarely pay anything extra. Some of them, there are people called dividend investors, equity dividend investors, and they'll look for companies that typically raise their dividends every, 6, year and a half, every 3 years, and there are companies that have raised their dividends every year for a long-term time, and they call them dividend kings or dividend, things like that. But the actual yield on the price is typically not that high. There aren't a whole lot of stocks that pay even a 4% dividend.
And not all stocks give dividends, so it's something
Right.
to keep in mind. All right,
For
let's go to
example-
number 2.
Okay, like most of the tech sector doesn't pay any dividends at all. Number 2 is diversification. And since I use funds of stocks and funds of bonds called closed-end funds, I'm looking to see a large number of entities inside each of the closed-end funds. So I know that even for a small investor just starting out, he can buy a closed-end fund for a minimal amount of money, couple hundred shares of it, but actually own hundreds of stocks. Instead of going out and buying one share of NVIDIA, he can buy 100 shares of a closed-end fund that's in the stock market and own a piece of thousands of shares of NVIDIA and another 375 stocks as well. So it's a different type of thing. So what I look for in my looking at these closed-end funds is their diversification on the inside. How many different bonds, how many different preferred shares, how many different mortgages or pieces of property do they own, stuff like that. So that's the second pillar of risk minimization. Third one is income generation. You want to get, one of the things my father told me, he said, never do anything or buy anything that doesn't give you some sort of income. And that's always been one of my credos. It's got to pay income. And there are literally around 200 or 300 high quality stocks that pay dividends. And there are about the same number, about 250 that meet all my requirements in closed-end funds that pay significant dividends. And the thing about the closed-end fund is the dividends are really significant. Like today, you can buy 75 different tax-free municipal bond closed-end funds that pay over 5%, some over 7%. I mean, it's unusual, and there are a lot of reasons for it, which we could go into, but that's more technical. It's mainly a function of interest rates and where they've been and how they just changed so drastically in a short period of time that's caused that. Eventually, the prices will catch up, but that's the type of thing. Equities and other types of fixed income closed-end funds are paying in the 9 to 10% range right now. And they contain the exact same securities that everybody else uses, the individual stocks, the individual bonds, preferred shares, and stuff like that. They'll even contain REITs, if you're familiar with REITs.
Yeah, real estate investment trusts.
Yeah. They can be inside of a closed-end fund, so you don't have the tax problems that are associated with the REITs.
Mm-hmm.
So that's income is the third leg of the stool. And the fourth one, and this is where most people just are letting the tail wag the dog, so to speak, is profit taking. If you don't take your profits, total return means nothing. And I'm saying that, and every one of your listeners, particularly if they're professional investors, are throwing their hand. What are you talking about? Total return doesn't. Well, total return is just a number. You can't spend it. You got to sell something to make that realized return. Realized return can be spent if you have to spend it, but it also can be reinvested, and you create more capital with the reinvestment of it. So instead of having 3 houses on your monopoly board, when you take the profits, you now can buy 4 houses, and on and on and on. Eventually you can build a couple hotels. So profit taking is a very, very important element. How many people, my age, in my lifetime, my investment lifetime, I've experienced the crash of 87, the dot-com bubble, the Great Recession, and the little COVID scare, So 4 times where prices fell by 40%, maybe more. And in not one of those situations did I have to sell anything or did I have to take my losses or anything like that. I could just sit back, take the income I was generating and reinvest in those same great securities at lower prices, increasing my yield and decreasing my cost basis for those securities.
Compounding, rule of 7.
Compound. Okay. So the rule of 7. The two other things are more conceptual and mindset type things. The one is that there is a market cycle and it will change consistently, but not predictably. Right now, for example, if you could look at a chart, you could see that we are at an all-time high in 2 of the 3 major averages, in the stock market. But bond prices or interest rate sensitive securities are still way below where they were 5 years ago because we've only been at 5% for such a short period of time, and we got there so quickly. We are at 0% for 12 years, and then in 18 months, we went from 0 to 5.5%, 6%, which forced prices down. And although those prices are now well above where they were last year, particularly the last 2 days, since we had a good inflation report, they're still nowhere near where they were 5 years ago when interest rates were very, very low. So that's the market cycle. You can always determine where you are. So that dictates if we're high up in the market cycle, I should be taking profits. And when I reinvest, I shouldn't be putting as much money into a security as I would have if it was lower in price.
That's an interesting concept, though, because if you look at the trajectory and the trend lines, it's difficult to tell if you are at that high point because it could continue to go higher. So retrospectively, it's easy to say, oh, that was that opportunity. How do you know when you're at the top of that?
You never know top. But you can tell right now that you're near the top or at a high point compared to where you've been. You have no clue what's going on tomorrow.
So are you saying you would exit then close or near when you believe you're at the top, switch into a different grouping, and then wait for it to drop and buy back in?
No, I'm not saying that. I'm not saying that. I never believe in any type of market timing or things like that. I set specific percent targets on everything I own. If I can buy in closed-end funds, I set a 5% target. If I can make 5%, I sell it. But I'm going to take that money out and reinvest it. And I'm looking at the market cycle to see how much I should make. If I normally reinvest $6,000 in a new position, if I'm at the all-time high or at a high level in the market, I'm only going to invest 4%. Because when it goes down, I'll then add to that position. I have diversification. One of the rules of diversification is you never have more than 5% of your portfolio asset, your working capital, in any one security. So when I start off with an investment of between 1 and 2%. So instead of going in at the 2% level, I'll go in at the 1% level if I see that we're at a high at the stock market. On the other hand, I know we're at the lower end of the bond, in the bond categories. When I buy those, I'll be saying, okay, I can make my normal allocation into this new security because it's more likely right now that interest rates will go down, particularly when you hear the politicians, than it is that they're going to go back up. So it's more likely that, I'm getting a good, fair price now, and the prices are going to go up as soon as they say, like they just did. I mean, you could look at it. I mean, it was like crazy on the income side. Even when the market went down, it was yesterday, I think, that towards the end it went down a little bit. All of them did. But the income securities in the closed-end funds are all still up because of the prospect of lower interest rate. That's the market cycle thing. It's just where you are in the market cycle, letting that tell you how much you should invest in the things that you've already determined have the quality and the income and the diversification. That tells you how much you should put in, and having the target of the profit-taking target. I sold 11 different securities today profitably.
All right.
So,
and for those of you who are just tuning in or need a reminder, we're talking with Steve Selingut, the author of Retirement Money Secrets today. All right, Steve, what's the next pillar for you?
The final thing you have to do to really prepare yourself for retirement or for going for roaming the world on vacations whenever you want to, is to get a focus. Your focus should be on income rather than market value. You've seen the tagline on the top of the book, right? It says, market value fuels the ego, income fuels the yacht. And it's so true. You got to have income to take those trips. You got to have something to spend. You got to be able to pay far enough in advance to take advantage of the bargains that they offer and so forth.
Yeah, and we often say that if you're not following comprehensive estate planning guidelines, you're not missing the boat, you're missing the yacht. So there is that.
Yeah. I mean, I guess financial planning is a much broader concept. It takes into account all the legalities, all the heirs, all that complicated legal stuff that I don't pay a whole lot of attention to. I probably cause people some tax problems, but they understand that going in. But from the preparation aspect of, planning for those eventualities. This methodology is great because it puts everything in liquid form, generating a lot of income. So there's typically no pressure at all to have to sell things to pay expenses even. I mean, even to pay funeral expenses. Some people are forced to sell something to do it.
All right, Steve. So for listeners who might feel overwhelmed by financial planning or investment management, what advice do you have for them to get started?
Well, certainly you don't want to wait to get your financial house in order so that it's the same time you're calling your estate planner. When you start investing, or when you discover that income is important to investing, you have to start getting a handle on what you have and discover ways to generate more income. And I think, the book over my shoulder there is a first step because it goes through step by step how you vet securities for what you want to produce. They're safe because they're funds, and funds of funds is a safer portfolio than a bunch of individual securities that you have to watch diligently all the time and listen to the news and who knows what's going to happen next. Whereas here you're, in a sense, you're hiring 100 or more professional managers to do that for you. And they pay you a large amount of income for that privilege. They get high fees, but your income is after all fees that go to the managers of these closed-end funds. So, it's in my experience over the last 25 years that I've been using them exclusively for all income-focused investing. And for ever since the financial crisis, I've been using it for stock market investing because mainly I no longer had stocks that were going down, high-quality companies that were going down 20% anymore because we had such a huge rally from the Great Recession on. So using closed-end funds, I was able to maintain my positions in all there is about the stock market, get paid high percentage distributions for my efforts, and trade them just like I was trading stocks for years before that.
Well, final takeaways. If listeners want to find you, if they're interested in picking up a copy of Retirement Money Secrets, where do they go?
Retirement Money Secrets is available at Amazon and pretty much any place else you want to get ebooks or something like that. The audiobook is only available through Audible and Amazon. I have a website called theincomecoach.net where you can read more about me and about the process and also about how coaching could maybe help you get started in this transition from your chasing market value to working on developing a growing stream of income and capital.
All right. Steve, thank you so much for your time. We enjoyed the conversation. That wraps up another Buried in Work podcast episode where we feature tips and stories from industry professionals who specialize in making estate planning, end-of-life tasks, and estate transitions more manageable. If you enjoyed the podcast, please consider leaving a review, follow us on social media, or of course, come visit us at buriedinwork.com. Don't forget, podcast listeners can save 10% off Buried in Work's estate preparation package or our games with code BIWPodcast. Steve, thanks again. It's been a pleasure.
My pleasure, Adam.
Thanks for listening to another episode of the Buried in Work podcast. Remember, you can save 10% on our estate preparation package and games with code podcast10 at buriedinwork.com.